Welcome to this discussion of the Terrorism Risk Insurance Program. This is your host, Jason Shoup, founder and managing member of the Centers for Better Insurance. Every 2 years, U.S. Treasury issues a report to Congress on the performance of the Terrorism Risk Insurance Program. The last two reports, issued in 2018 and 2020, include data on insured losses and federal backstop reimbursements expected under loss scenarios developed by Treasury. Each year, Treasury conducts a mandatory data call for participating insurers, which includes the description of a hypothetical terrorist attack. Using a terrorism loss model, each insurer is required to calculate and report its expected losses and other data relating to that hypothetical attack. This data is reported in a way so the Treasury cannot identify individual insurers. Today, we're going to take a look at 5 modeled loss events. Before we do so, let's review how the Terrorism Risk Insurance Program's backstop works. Each insurer or insurer group is assigned a backstop deductible equal to 20% of its prior year direct earned premium for relevant lines of business. If we added all of these individual insurer deductibles up, it would total somewhere about $41 billion. Once an insurer has satisfied its deductible, the backstop, meaning U.S. Treasury, reimburses the insurer 80 cents of every dollar of insured loss above the deductible. The insurer remains responsible for the other 20%. If the total of all insured losses across the industry, whether or not reimbursed by the backstop, reaches $100 billion, then the program is capped out. Once the cap is reached, claim payments to policyholders are prorated. Finally, the backstop payments are subject to a $200 million program trigger. Even if an individual insurer has satisfied its deductible, it cannot receive reimbursement if industry losses do not exceed the $200 million program trigger. The program trigger keeps smaller events out of the backstop. As we go through each of the 5 modeled loss events, watch for evidence of the following 4 points. First, captives dominate the program, especially for events smaller than September 11 and for NBCR terrorism. A captive is an insurance company set up as a private, dedicated insurer for its owner. Typically, terrorism captives are set up by large corporations that can afford to capitalize and manage their own insurance companies. Second, captives take far more out of the program for every dollar paid to a policyholder in claims than traditional insurers. As you will see, TRIA is really a program designed for captives. Third, small businesses, nonprofits, and local governments who do not have the resources to set up their own personal insurance companies get the short end of the stick under the program. All the money Treasury pays out to captives gets marked up by 40% and billed out to regular policyholders in the form of surcharges. Finally, many small insurers have complained about the $200 million program trigger. Treasury's modeled loss scenarios show it is completely irrelevant. The program trigger could be increased to $1 or even $2 billion, and it would not impact traditional insurers, although captives and non-U.S. insurers would feel a pinch. The first event Treasury developed was a large conventional truck bomb attack in Midtown Manhattan just before lunch during a workday in June. The loss amounts reported are only for property and workers' compensation losses. Liability losses are not contemplated in this or any other scenario. The insured loss amount is roughly on par with the September 11 attack. While captives play a significant role, captives are reimbursed only about 80 cents for every dollar of loss, as compared to 40 cents for traditional insurers. Note that while Treasury pays out $18.5 billion to insurers, it must collect $25.9 billion from small businesses, churches, school districts, and other commercial policyholders through policyholder surcharges. This next event involves two coordinated conventional bombings, one at O'Hare International Airport and another in the Loop in Chicago. Although traditional insurers pay out 75% of the losses from these attacks, they receive only 5% of the reimbursements paid out through the backstop. Captives are reimbursed 75 cents on the dollar from the backstop, while traditional insurers are reimbursed only 2 cents on the dollar. Again, small businesses, nonprofits, and local governments get hardly any benefit from the program, but receive a bill from Treasury for 140% of the payouts large corporates engineered through their captives. For the 2019 data call, Treasury described two coordinated attacks in San Francisco, but reported out the data separately. The first attack is a conventional bombing in the heart of the tourist district. Here too, captives are paid out generously, 66 cents on the dollar paid to large corporates, while traditional insurers receive 3 cents back for every dollar paid to a restaurant, church, or retail shop. The second attack described in the 2019 data call is a dirty bomb in the central business district of San Francisco. Traditional insurers play a much smaller role in this scenario, probably because regular property insurance policies contain nuclear exclusions, so would not pay out. Workers' compensation policies, which have no exclusions, would pay. Captives pick up nearly half of insured losses because the policies they issue often cover so-called NBCR events. Even though small businesses, nonprofits, and local governments do not get paid by their insurance companies under this scenario, they still get the bill for the generous coverages captives provide to their corporate parents. This last event involves two simultaneous truck bombs at a mall in Dallas at the height of the retail season. This is by far the smallest event Treasury has asked insurers to model. Treasury would make backstop payments only to captives, of course, and to non-U.S. insurers. Even though this loss event is 9 times larger than the program trigger, not a single traditional insurer would receive a recovery under the backstop. You can learn more about the Terrorism Risk Insurance Act and the outsized role of captives at www.betterins.org. On behalf of the Centers for Better Insurance, thank you for spending this time.